lunch. And the guest, of course, is Treasurer Paul Keating, today on his 10th visit to the club, and he's just written in our visitor's book, he's described it as his 10th happy budget occasion. We'll see if that's shared by all of you. Would you welcome Paul Keating?
Thank you very much, Mr. President. Ladies and gentlemen, I'm not sure this is working, is it? Is it firing? Well, this is the 10th occasion, and I've had the honour of addressing the National Press Club following a budget or a May statement, and I certainly appreciate the opportunities. On these occasions, I've attempted to develop themes which reflect the political and economic context in which each of these major economic statements have been delivered. My message today is that optimism about Australia's economic prospects in the short and medium terms must not obscure the need for a continuing and vigorous reform agenda. Although the tensions associated with the earlier collapse in commodity prices have eased, it does not mean Australia can rest on its oars. On the contrary, yesterday I said that this budget is the right one for Australia at this time. But why? Well, because it's framed responsibly to use the income lift from our terms of trade to lay the foundations for sustainable, low inflationary growth. It is important to remember that a dominant feature of the economic landscape for this financial year will be the rise in our terms of trade, even if there is no further lift in export prices on top of last year's increase. This is in marked contrast to the previous 2 years, where terms of trade falls detracted markedly from national income. But just as this government proved it had the skills and political courage to manage national income losses, you are now seeing national income accretions being deployed judiciously. By eliminating totally the new money borrowings of the whole public sector, by repaying Commonwealth debt, by rebuilding the capital base of private business and cementing in a strategy to beat the inflation disease. Our approach stands in sharp relief to the public policy negligence of governments in the post-war years who rode to office on the back of the simple notion that commodity prices would keep rising forever. The political advantages of rolling with the good times soured by the early 1980s as we began to wake up to the fact that the dynamism in world trade had simply passed us by. The structural weaknesses in the Australian economy, exposed by the terms of trade developments of recent years, did not spring up overnight, nor did they develop just in the last decade. In fact, they were mainly the product of the 1950s and 60s, the so-called golden era of economic growth. Around the world, with post-war reconstruction, the dismantling of wartime trade barriers and the fresh memory of hyperinflation combined to produce 2 decades of strong expansion. In Europe and in North America, it unleashed powerful new forces as the gains from international trade were recognised and were reaped. But during those decades, governments around the world sowed the seeds of their own decay through misplaced interventions in their own economies to buy off this or that interest group. The Western economies became increasingly hidebound, public expenditures accelerated, and inflationary tendencies mounted. The same pattern, but without an involvement in the world trade and manufactures, was also evident in Australia. We too experienced a long period of sustained growth, living off the exploitation of our natural resources and the external borrowing necessary for their development. But we went further. Australian governments of the day relentlessly set about developing an inward-looking economy in a vain attempt to develop manufacturing behind massive tariff barriers. What emerged was not just a manufacturing structure without a future, but a whole host of inappropriate wage structures, work and management practices and regulatory props. The benefits of the protection were dissipated as they were shared around, of course always at the consumer's expense, to become ingrained in anti-competitive attitudes. The oil price shocks of the 1970s, themselves largely the product of accelerating inflation in the West, called an end to the party. Policymakers in most countries were found wanting. Productivity slowed, inflation accelerated, and unemployment rose. Trade barriers were raised and industries were even further bricked up. In Australia, the complacency born of earlier years allowed us to see no irony in providing protection for 40-year-old infant industries. We thought we could afford wage rises which were multiples of our trading partners. We thought government spending should be limited only by the creativity of ministers and the big outlay portfolios. We expected the next upswing in the world economy to restore our fortunes and kept on borrowing in the meantime. The 1980s exposed our deficiencies in no uncertain fashion, firstly with the recession of 1982-3 and then in 1985-6 with the collapse in our terms of trade. Australia had thus to come from behind the pack, but come up fast. Well, we're now doing just that. This government seized the initiative on structural change from the time it took office in 1983. We saw the opportunities and we produced the decisions. The removal of exchange controls and the floating of the exchange rate still count as the first, the boldest and most profound of our moves. With them, we unleashed a vigorous and modern financial system. We reformed the tax system that had decayed and fallen into disrepute. We deregulated oil marketing and set in processes for the deregulation of air transport. With the May 1988 economic statement, we produced the most profound package of structural reforms in this country's history. And in last night's budget, we've taken financial deregulation a step further, and a final step indeed, by ending the archaic distinction between savings and trading banks and by phasing down the statutory reserve deposits and ultimately replacing them. If our economy is to become more flexible, as it must, our labour force must also become more flexible. Our people must become better educated, better trained, and their education and training must become more relevant. The government recognises this. More importantly, so does the trade union leadership and many business leaders. The challenge is to convert that recognition into workable changes, changes which both encourage better education and training, which better reward the results, and which better distribute the costs of providing skills acquisition. The government believes that those ends will be best served by a coordinated approach which requires some degree of cost recovery to increase the total resources available for education and training and lifts the profile of adult retraining. The recent national wage case decision provides the framework for employers and employees to negotiate award restructuring, which places greater emphasis to training in all its dimensions. As you know, the Conciliation and Arbitration Commission has determined that a structural efficiency principle will be a key element in the new wage fixing system. That principle requires parties to examine awards to establishing skill-related career paths, to eliminate impediments to multi-skilling, and to improve the flexibility of working patterns. To take the Commission's own words, its purpose is to facilitate the type of fundamental review essential to ensure that existing award structures are relevant to modern competitive requirements of industry and are in the best interest of both management and workers. Unions seeking to achieve the wage rises set out in the Commission's decision must first commit themselves to a review of their awards to access the system. You may recall that following last year's budget, at this gathering I observed that labour market reform would have a place at the top of the government's agenda for its third term. In the event, I think expectations in this regard have more than been met. With a great deal of the second-tier restructuring behind us and with the prospect of now making further inroads, few will dispute that we are firmly locked onto the target of further raising the efficiency of the labour market. The national wage decision not only helps chart the way forward on labour market restructuring, but it also will assist the government accelerate its anti-inflation strategy, enabling continued wage moderation throughout 1988-9. The Commission has placed considerable reliance on the government's intentions in relation to personal tax cuts and the slowing of the rate in inflation. In this budget, the government is keeping faith on both counts. As I announced last night, the following negotiations with the ACTU early next year, tax cuts will be paid from 1 July next, and that to maintain the downward momentum in the Consumer Price Index, the taxation of beer would be reformed at a cost to revenue of $400 million. The latter measure will bring substantial and immediate reductions in beer prices and reduce the CPI by about 0.5 percentage point. The government is aware, however, that the states may also apply tax or fees to beer sales, and I take this opportunity of saying that this reduction should not be thwarted by the states increasing their own taxation on beer. With moderate wage growth during 88-9 and successful conclusion of a wage tax trade-off, Australia can achieve an inflation rate of 3 to 4% in 1990. As much as any other outcome, this will enhance structural reform in Australia by preserving the international competitiveness we finally found in the late 1980s. Let me just return briefly to the elements of the budget that budgets are made of, and that is spending, taxing and borrowing. Despite the fact that we've taken 5% of GDP off Commonwealth outlays in 4 years, despite the fact that the PSBR in the year ahead will be zero, and despite the fact that we will redeem $6 billion worth of government debt this year, we still hear calls for further savage cuts in public spending. These are either a product of failure to look at the facts or the mindless quest for a fireworks spectacular on spending each time I deliver an economic statement. The discipline in fiscal policy now rests in the tight link between the forward estimates and the actual budget numbers. That is, the forward estimates have become progressively tighter, so the need for huge annual cuts from the forward estimates has diminished. Putting it another way, each successive year for the past 5, we've been making our cuts from a lower base. In May, I said to you, as we turn the screw stays turned. It doesn't spring back, and therefore we don't need to keep on turning it by the same degree. This government has sifted through Commonwealth budgets time and time again, programs time and time again, with 10 statements of savings in 6 years, and it's earned every inch of its budget flexibility. Our record of thoroughness in reviewing and restraining outlays is unmatched anywhere in the OECD. No other developed nation has wound back total public sector outlays towards levels of 15 and 20 years ago. The fact is, we have a public sector this year the same size as it was in 1973. If anything, the trend elsewhere has been in the opposite direction. So we are therefore not to respond to just disingenuous lectures by Mr Howard, Mr Peacock or anyone else about the capacity of the public sector to sustain further massive cuts. We assess expenditure cuts by what is appropriate to economic management and social justice, and not in slavish submission to some empty incantation. May I, in conclusion, remind you that Mr Howard has the responsibility of bringing down the opposition's alternative budget tomorrow night. 20 minutes or so of prime-time television. We are now well over 1/3 of the way through this parliament, and not one slither of detail from the opposition on how they would manage the economy has yet appeared. Tomorrow's test for the opposition leader is to produce some specifics to support his contention that there are huge areas of the public sector just sitting around waiting to be cut. It is also his greatest and perhaps his final opportunity to abandon seamy race politics and get back onto the main economic game. Thank you.
Thank you, Mr Keating. We'll see now if we can have our own fireworks spectacular during question time. There are a lot of questions, usual warnings that could you keep them brief, please. The first question's from Lorenzo Boccabella.
Treasurer, last night you said you got a buzz out of presenting budgets. Treasurer, what I think Australia wants to know, how long is it going to be before you stop getting a buzz out of presenting budgets?
Well, if people like you keep appearing at these audiences, why, it might just go on forever.
Stay standing, otherwise you keep disappearing from the screen.
Chris Falvey, Australian Associated Press. Mr. Keating, are you concerned that a further appreciation in the Australian dollar will take away some of the competitive edge industry has already gained? Or do you think that Australian industry will have to learn to live with a fully floating dollar and not rely on a dollar between 75 and 80 US cents?
Well, the fact is we have appreciated substantially over the last year or so, reflecting the increase in the terms of trade. That's not something which is difficult to comprehend. But against the trade-weighted index, we're still about 26 to 30% down on where it was when the dollar first fell. So our competitiveness is still there. And the fact is the appreciation of recent times will be itself a major influence in the contraction of inflation. Now, we have in this budget about 1.5 percentage points off the CPI for the rise in the dollar. But in fact, let me just make this point, the TWI, the trade-weighted index, has appreciated by around 13% since the March quarter of 1988. Import prices account for around 25 to 30% of CPI growth, so that potentially the appreciation might finally reduce CPI growth by about 3 percentage points. Lags and the possibility that retail prices lead us, and the fact that there may lags and the possibility that the appreciation may not be fully passed on to retail prices, lead us to use a figure of 1.5 percentage points during 88-89. We are using half the mechanical effect, the assessed mechanical effect, which is 3 percentage points. We've also got 0.5% coming from the decision last night on indirect tax. So there's 2% reduction in the CPI coming from that terms of that appreciation plus the fiscal measure, which is going to help restore and maintain the competitiveness that you speak of. Plus the fact we'll have the unwinding of the fresh fruit and vegetable rises which came with the unseasonal rains down the east coast this year and which are so heavily weighted in our CPI basket. But we don't have anything in the CPI assessment about those. So it's an ill wind that blows no good in economic policy. There's always some other consequence of an economic change. And if the dollar has appreciated somewhat, it's because we've got more national income coming from the terms of trade, a better current account balance, and for many of the producers who may feel that they are disadvantaged by the dollar rising, they are advantaged by the higher income coming from the terms of trade. And the appreciation of the dollar is in fact reducing the consumer price index and inflation, which itself maintains your competitiveness.
Don Wolford.
Don Wolford from AAP, Mr. Keating. In your statement last night on the banking reforms, you said the government had already sought and gained assurances from the major banks that the benefits of this change would be reflected in their interest rates. Could you tell us, please, what the nature of these assurances were? Did they include home loan interest rates? And are you disappointed by the very cautious reaction by the banks last night and this morning to that?
No, I think the bank's reaction has been reasonable. In the formula which sets interest rates, the SRDs are simply a part of the formula and a part of the calculation. And the assurance is that they will remain part of the formula and part of the calculation, and that the reduction in the impost on banks will not go to bank profitability. That in fact it will be passed on in lower rates. And I've got every reason to believe that those assurances will be honoured.
Michelle Grattan.
Michelle Grattan of The Age. Mr. Keating, you and Senator Walsh have disagreed in the past about the desirability of bringing the personal top tax rate down to 39 cents to match the company rate. Can you now be somewhat more precise on whether you think the government ought to match the company rate and whether it will be able to do so? And secondly, what are the arguments for and against phasing that top rate down?
Well, let's be clear about what our objectives have been in tax policy. It has been to broaden the tax base, to cut rates, to make the system more effectively progressive. It may not have been now and may not be now as nominally progressive, but in fact it's more effectively progressive because more people are paying their tax. In other words, more people are complying with the rates which now appear in the schedules. And in the end, any test of tax policy gets down to that. It doesn't get down to cosmetics or feelings or warm inner glows. It gets down to whether people pay tax at the scheduled rates. The fact that we've got this buoyancy in compliance now means more people are paying tax. Now, I made the point in 1985 and since I'll make it again. That is, if your marginal rate of tax is 0, you will have 100% compliance. If your marginal tax rate of tax is 100, you'll have very little compliance. Everywhere you move back along that line to 0, you get more compliance. When we moved from 60 to 49, we got more compliance. If we moved from 49 to 39, again we'd get more compliance. So we've been about broadening the base and cutting the rates. Now, in the forthcoming tax cuts, we'll be looking at the lower to middle income ranges because we've already seen a substantial size cut in the top rate. But I must say, that never came as a benefit to that group because we received more than the cost of that cut in increases from the fringe benefits tax, the abolition of entertainment, and all of the other base broadening measures, including capital gains. We've had more from that group than, in fact, we've repaid to them by cutting the rate from 60 to 49, a point not appreciated by many. So you may argue that those people have not yet had a tax cut in real terms. That's not to say some individuals within that group have not had a tax cut, that is those who were not into income minimisation and the rest. But as a group, one could argue that, and argue convincingly, that as a group, it's been basically a one-for-one change in terms of revenue versus loss. Now, we have a company rate at 39%. Why? To get the rate back to the rate akin to the major industrial economies. Why? To avoid tax arbitrage. Other reason why? So we can abolish the foreign tax credit system. Why? So we can stream dividends home to the Australian current account from Australian earnings abroad. That's why. Not because I've thought of the lowest number I could get up. That's why. And I mentioned last night the great constellation of companies we're building offshore. We've already built about $34 billion worth of assets offshore. If we imprison their dividends, they will grow bigger and larger, and therefore is then always the temptation to headquarter in the markets they're operating. Now, if you put a pipeline from those retained earnings back to Australia by way of dividend distributions in the absence of a foreign tax credit system, which you can only abolish when the rate is comparable to the countries where you're operating, you've got a chance then not only of maintaining them as Australian-based companies, and we've also got the other jam, the other vice, the other screw of imputation keeping shareholder loyalty in Australia, which isn't evident in other countries, then that dividend stream will countervail the income stream, the interest stream which comes off our foreign debt. And as we build those assets up, we'll be building up a bigger dividend stream. That's why the 39's there. Now you ask me about the alignment of the rates. Well, the fact is, the nearer the rates are, the better. The nearer they are, the better. The less there is the possibility of arbitrage in those rates between the personal and company rate. But anyone in this country who has wealth, income, are mostly incorporated. I mean, I guarantee you half the press gallery is incorporated. And it's entirely sensible. I'm not attacking you for it. It's a thing you do when the tax system urges you to do it. And the fact is, if for those who think that we've got some kind of penalty on people by sticking with higher marginal rates, well, you've got a penalty on those who can't escape it. Public servants, politicians, all the people who are not incorporated. Now that's the facts. And the question about equity is about effective rates of progression. So my objectives are to bring down the lower to middle income tax rates. A parallel objective with Peter Walsh. Peter has disagreed with me on occasions. He did about the 60 rate to 49. And I don't think Peter would mind me saying that he was wrong and I was right. and that the proof of the pudding is in the eating. The compliance simply is there. The compliance is there. And it is there in the Commissioner's reports and the statistics, and it's a point, I think, which weighs quite heavily on Peter Walsh, and that's why he hasn't made his mind up about this issue, and I haven't made mind up about at what pace we ought to, first of all, whether in fact fiscal policy can afford a change to 39, the top marginal rate, at this time or in this intermediate period, and even if I thought it could afford it, at what pace that decline ought to be accommodated, whether it ought to be accommodated instantly or over time. But the priority of both of us, and that's what matters, and there's not much difference of view between Peter Walsh and me on almost any matter that carries on within this government, is that the priority is to cementing up the wage system and breaking the back of inflation.
Paul Kelly.
Paul Kelly from the Australian. Mr. Keating, do you agree that one of the risks in the strategy is that the economy might grow too fast and hence there'll be a need for interest rates to increase? If you disagree, how confident are you that interest rates can fall and when?
Well, I do disagree. I think that's not to say one can be cavalier about demand, but what are the sources of demand? Now we've got 4% in the budget for gross national expenditure, 3.5% if you exclude aircraft, which are simply all J-curve imports. They're all there to increase tourism receipts and to turn the current account around. Now, if you disaggregate those numbers, you'll find that consumption is 2.75%. Consumption is right on the last 10-year average. The 10-year average, which you'll find in the budget papers, is 2.7%. We've got 2.75 in. So we've got consumption running at about average. Where the extra components of demand are coming from is investment. The great story of this budget is investment, 12% real. You won't find that in any set of budget papers around the world at the moment, 12% real. And that's the mix, that's the magic mix. Modest consumption, strong investment. So if demand, your demand point is if demand's running too much and that has current account implications, well, the only implication you can draw at the moment is we are building a bigger and better supply-side response by putting in more capacity to import, compete and export than we've ever had. And if you look at the budget papers in terms of our export to GDP ratios, I'll just find the reference because it's worth focusing you on it. Page 43, you'll find a very nice chart in there which shows, not a nice one, an exceedingly nice one, which shows this tremendous rise in the ratio of exports to GDP. Now, in other words, we're putting all that supply response in there. It's all going in. And that's why it's such a good mix. And that's when I said about bringing home the bacon. That is the magic mix of this budget is 12% business investment, 2.75% for consumption, 0 for the PSBR. Now, the Financial Review thought I meant bring home the bacon for the Labor constituency. I actually meant bring home the bacon for the Financial Review because I used to think it was interested in investment and consumption and public sector borrowings, but the fact is they are there, and it is, rashers of bacon on a very large scale, plenty of it, and that's why we've got that mix. I think pretty nice.
Rob Hadler.
Rob Hadler from The Australian. Mr Keating, in your speech today you've warned the states not to increase taxes or fees on beer to offset the effects of your announcement last night. What action would you take to thwart the states from doing this if they go ahead and defy your warning?
Oh, well, I just hope they don't, that's all. I think it's fair enough if the Commonwealth takes a specific measure to, one, reform the taxation of beer, which is the most perhaps significant beverage by volume consumed in this country, at the same time seeking to draw to it macroeconomic effects. I don't think it should behove the states to try and upset that and seek to exploit that opportunity. And if they try, we might have to look at that then.
Jim Middleton.
Jim Middleton, ABC Television. Treasurer, you've already said that the level of next year's tax cut is dependent on the extent to which there's wage moderation. Is the level of the tax cut similarly dependent on the extent to which the current account deficit and domestic demand meet your expectations in the coming year?
No, not. Well, I can't say, to be precise with you. Of course we look at all of these things. We look at demand, but we'll be mostly looking at wages growth over the course of the year, and the G&E, the demand trade-off that we are able to negotiate with the workforce in relation to tax cuts. I mean, that's the thing that would matter most. But you asked me about the terms of trade, and let me pick up another point. In today's newspapers, we've seen some some talk of risk, that the budget's got some basis of risk, that we're relying on a 9% rise in the terms of trade. If it doesn't come through, the whole thing may fall to the ground. Well, that simply indicates a lack of understanding of what those statistics mean. And that is, we're talking about year average figures. Now, we're talking about 9% in year average terms over last year. But it means that commodity prices do not have to increase by 1 cent above where they are now. And the reason why that is, if you take, for instance, an 18% rise in commodity prices, which I think was last year's figure, off a low base, the average is about halfway, 9%. If at the 18 point there is no further increase in commodity prices, you've got a 9% difference. So you've got a 9% increase in year average terms, but no higher commodity prices. Now, this was not understood by the Financial Review, which is supposed to be our premier economic paper, but isn't. And it was not understood by a lot of other, and I'm not attacking people from the Canberra gallery here, I've got much respect for them, but for the major financial paper to not understand the difference between year average terms on terms of trade, and to predicate an editorial on that basis saying it's risk, where in fact we are implying no further increase in commodity prices, and where the OECD has said, let me just quote from them, that on the basis, this is from the report the other day, on the basis of the projected growth of industrial production at its trend rate of 3 to 4% in the second half of 88 and in 1989, average non-oil commodity prices in US dollar terms are projected to remain roughly unchanged in real terms. Given high prices at the end of 1987 compared with the average for the year, this would imply an average 1988 level 15% higher than that in 1987, the very point I've just made, and an increase of little less than 2% in 89. So in other words, they're saying, just as we are, an increase in average terms of trade, but no increase in commodity prices. Now, I refer you also to the budget papers at the chart on page 32, where we have charted out the inventory position of all the major commodities. And you'll see all of these ones down: aluminium, copper, nickel, zinc, lead, wool, wheat slightly down, sugar slightly down, but the others heavily down. In other words, a much better balance between inventories and demand. So, I mean, there's not going to be some collapse like that, and not with the growth around and the way inventories are, and given our very conservative forecast of a 9% lift in year average terms, but implying no further increase in prices as they as they now are, means that this whole notion of some risk-based strategy is, of course, rubbish.
Steve Burrell.
Mr. Keating, Steve Burrell from Australia's premier financial journal. The budget strategy is, as you've pointed out several times today, based very strongly on a surge in investment as the basis for continued net export performance in the future. However, recent investment figures and in particular expectations of investment indicate that most of it is occurring in areas other than manufacturing. Can we really bring home the bacon over the next few years if the manufacturing capital base is not building up?
Well, look, we've got in the budget 11.5% increase real increase in investment in plant and equipment, right? The very thing you're talking about, plant and equipment. And the point I'm making, it's the very thing the Financial Review has been on about. I mean, the story for this budget for the Financial Review was investment 12%, equipment investment 11.5%, PSBR 0, consumption flat, right? That's the story that the financial markets want to know about. That's what the FT would have run. That's what the business pages of the Wall Street Journal would have run. The fact is that I think it is a pity that basically these points were not observed. And so the fact is the bacon is coming home. We've got the investment there. Now look, I'm not don't want to make too much of a point of it. The Financial Review treated me quite kindly today. You mightn't think so, but it did. And I appreciate that kindness. But we rely upon its distribution all around the world. We rely upon its distribution in London. We rely upon its distribution in New York. We rely upon its distribution in many places. It's faxed to these places. And it's still being edited by people who grew up in the days before we internationalised the Australian economy. They are still running around with McEwenistic views running through their minds and this sort of reference model. Well, it may be a bit of sort of, shall we say, newspaper archaeology or some sort of quaint loyalty to those who have served well in the past. But look, we have internationalised this place. We've got a modern financial markets. Everyone's got a Reuters screen in their office. And the references of papers like this must be, the professionalism of these papers must match the professionalism of the government and the financial markets. And we can't have the newspapers straggling up the rear with substandard analysis and no, I mean this sincerely, with substandard analysis and with references to an age of economic stupidity which was permitted by high terms of trade. Now, I've answered the question, but again, the gamble. The fact is, some commentators, I feel, this is not the Financial Review, I'll let them off at this point, think that the terms of trade should have stayed down. It's shocking to have all this income because it blots out net exports. You see, you're better to have the net exports and no income. The very point of the net exports is to change the current account. The terms of trade income pumps the current account down. You can never say, oh, here's a flow of money. Oh, no, thanks, we don't want it. You can't ever say that. The gambler would have paid tax cuts now and wasted the benefits of the commodity gains. Equally the gambler would have tried to rush a wage tax trade-off now, wasting the advantages of the existing wages system. We're applying the income surge to the centrepieces of this budget, the PSBR to 0, investment to 12, and I don't think the government can be accused of applying the income surge to those objectives, that is, to knocking down the PSBR and lifting investment, as being risk-taking. And if the analyst that analysis doesn't grab you, the biggest guarantee against the risk gamble, frankly, is that I remain in charge of economic policy. And that if the terms of trade go off, well then the full weight of fiscal, wages and monetary policy will be deployed against it, instantly deployed against it. So the fact is there is no gamble there. And, I just make this point, again, about the terms of trade. If you get higher terms of trade, you get more income, more farm incomes, more other incomes. Incomes get spent. Some income gets spent on imports. So you then have generally a higher level of imports matching a terms of trade rise. The point is, when that terms of trade happens to fall away for whatever reason, those imports will fall away as well, provided and the net exports will pop through, providing your supply side is pumping the investment in the import replacement export industries. That's what we're doing. We're getting all that investment in the supply side, and whether net exports are visible now or not is immaterial while this high income flow is there. But if it goes, so will the imports. It's a very nice situation for us.
Paul Malone.
Paul Malone from the Canberra Times, Mr Keating. As there appears to be no chance of you becoming Prime Minister in the foreseeable future, have you considered or have you been considering getting out of politics, as some have suggested?
Well, I know you'd like me to, Paul. You're always writing about my career. No, I continue to stay in this job and continue to play my role in making the Labor Party a modern political party with modern capacity, and to make the Australian economy more robust, more adaptable, more competitive, more international than it is even now. And maybe we're starting to get to the point where a couple of things I said in the budget last night are being understood. That is, that good economics are good politics, and a smaller public sector can be a better public sector. That all of the things that have to be rendered to Caesar in terms of those in need, the disadvantaged, can be handled by a growing, competitive, robust, lean economy. And in getting to that point, as the Labor Party is now getting to it institutionally by endorsing the policy program I put to it in Hobart, and in its parliamentary party across all of its factions, we're starting to see the maturation of the party and understanding that it has the capacity and the creativity to run a modern industrial economy while at the same time remaining faithful to its basic objectives of employment and a fair go for those who need it. And that's why I hope that whatever role I've played in that I can continue to play a further role in that process.
Bruce Juddery.
Bruce Juddery, Australian Business. I'd like to get away from all the economic theorising and the career, and get down to something practical. Last night you promised us what today you called substantial and immediate reductions in beer prices, and last night you also told us that you're going to sue the Prices Surveillance Authority onto anybody who broke the rules. Now, last night on the way to the lockup to pick up my free set of the budget papers, I stopped in here and I bought a can of one of Mr Elliott's products, and they charged me $1.50 for it. Now, I came in here today, and this is very practical, I came in here today before this lunch, and I bought a can, and they charged me $1.50 for it again. I want to know, when are you going to keep your promise? How long is this going to go on? When are they coming in?
Well, the short answer to that is some of the amber fluid has already been through the bond, and the tax has already been, the excise has already been paid on it, and it's not a long pipeline in the bond. So what you'll find is some of the cheaper amber fluid starts moving through the process soon, and well, you'll be back in your seventh heaven. Just guzzle away.
Ian Davis.
Ian Davis from the Canberra Times. Mr Keating, another Prices Surveillance Authority question. You said in the speech last night that the Prices Surveillance Authority would make sure that the indirect tax cuts were passed on and not retained by the companies that that were affected, but there was no mention of the Prices Surveillance Authority in relation to interest rates and the cut that would come off the SRD changes. Why are banks, or why are interest rates exempt from Prices Surveillance Authority scrutiny, given the importance of interest rates to the entire population, including the Labor constituency?
Well, it's for the Prices Surveillance Authority to do the things which it should be doing in the places where there is not the degree of competition there is in other parts of the economy. That's its charter. But in relation to the major four banks and other banks, standalone banks, the central bank, the Governor, the Treasury, myself, we will know pretty well what's happening in terms of these interest rate effects, and we won't. It would be inappropriate to use the Price Surveillance Authority to start looking at these things. I mean, that assurance has been given to us, and this is a phased reduction, you must remember. It's over a 3-year period, and I'm quite sure that, you see, it's in the bank's interest to cut the margins because they are losing business to other institutions and they are doing much off-book business. They are not taking deposits because they have to lodge 7% of those deposits with the Reserve Bank at 5%. So they're into bill financing and overseas transactions and financing so that they can build a basis of liabilities away from deposits. They want to remove the distortion as much as we do. And we're not going to give them the freedom to remove it and let them, and them themselves, say, no, we want to keep it. They're as keen to see it go as we are. And that's why the compliance will be there, not because of any threats by us or any surveillance, but just out of pure commercial competitive interest. They will remove this distinction between themselves and the non-bank sector with as much speed as they can.
Robert Garron.
Robert Garron from The Age, Mr Keating. You've stressed the importance of restraining demand as a reason for delaying tax cuts, yet you seem sanguine about the problems this will pose in a year's time. In this context, how many years of bracket creep do you hope to be able to hand back in next year's tax cuts, and will it be enough to allow you to deliver zero wages growth in the following year?
Yeah. Well, not a novel question, my friend, but let me deal with it. Look, I think we ought to try and nail on the head this thing about bracket creep. We've got a couple of other people wandering around talking about bracket creep being in fact the reason why the surplus existing by virtue of bracket creep. It's not true. Bracket creep this year is worth about 1.4 or 1.5 billion. That's what it's worth. Now this year, in offsets to that bracket creep, we have given away the following: 400 million on beer, 250 million on the 2% revenue duty, which we abolished in the May statement, 110 million on the first year cost of the company tax cuts for companies which adjust earlier, 130 million on the tariff reduction from passenger motor vehicles going back into consumers' pockets, 110 million on the general tariff reduction going back into consumers' pockets, and more, at totals 1.4 billion. Those 1.4 billion is a direct offset immediately to any bracket creep. Plus, we've seen a 700 million decline in oil revenues from lower oil prices, which benefits consumers, and lower production, plus 1,000 million less from Reserve Bank profit. So there's a $3 billion offset to the 1.5 billion of bracket creep, right? So of course you pick up a bit more revenue. Tax PAYE. But the great rise in PAYE comes from the 5.75% forecast increase in average weekly earnings and 2.75% for employment. There are more people in more jobs earning more money, so the government gets more revenue. But the new revenue is, as you call it, fiscal drag or bracket creep, is only a thin slice of that. Now, if it's 1.5 billion, and we've handed back 3 billion, but the balance in the surplus has moved by another 3.5 billion above that which obtained, how then can anyone say that this surplus relies on bracket creep? Well, of course, it doesn't. And we have made adjustments to de facto indexation and the tax cuts of 1984, 1986-7, and we'll do again in 1989. Now that is basically the position.
Paul Bongiorno.
Paul Bongiorno, Network 10 Treasurer. I was a bit worried about the gamble that all the experts kept telling us about this morning, but you seem to have addressed that. I'd like to pick you up on this biggest guarantee that you can offer, and just wonder that as Prime Minister, would you be prepared to give your Treasurer the sort of latitude that you seem to have received under the present regime?
Well, well, I'm not Prime Minister, so I don't need to speculate about that. But the policy which I stand for and by has been the policy of this Cabinet. And what's been unique about this experience is that for 5.5 years we've had the same group of people presiding over the same policy with the same commitment to its change. And countries very rarely have 5.5 years of consistent policy application to the same objective by the same people.
Alan Thornhill.
Alan Thornhill, freelance, Mr Keating. Mr Keating, we're still looking at fairly big monthly current account deficits, despite the improvement. This will have to be funded by foreign money, and it's been coming increasingly in recent years from Asia. Do you see any trends in current political debate in Australia that might impose a penalty on that flow?
Well, but potentially there may be with the policies which Mr Howard is espousing. But I think that in reflecting on the current account, you need to be reminded that the current account deficit really peaked at about 7.75% of GDP, but only registered 6 at its peak, because as fast as it was rising, we were pulling it down with the policy changes, and the economy itself was equilibrating to the shift in the current account deficit. So it's really gone from 7.75% of GDP to 3. But in terms of the registered peaks, 6, 5, 4, and in prospect this year 3. Now the trend rate through the 60s and early 70s was 2.5% of GDP. 2.5% of GDP incurred no debt accretion because it was mostly funded by equity. So there is a point where your current account can fall to where basically it's covered by equity coming in. But I make the point, the equity which we have put out to our vast companies abroad is equity which has been drawn from the savings pool, which has had to be replaced by debt, current account debt. But there's never been any distinguishing in our national accounts about that extra debt being taken aboard to accommodate the equity shift offshore. But we are now starting to deal with that, and you'll find a quite illuminating section at the end of Statement 2, and which I referred to in the constellation of companies clauses in the speech last night, with the 34 billion of assets offshore. So in fact we have a higher debt now than in fact we probably need to have to accommodate the current account, the fundamentals of the current account. And so therefore it's entirely possible that, and that's why one must look at the future dividend stream coming off this equity. One must impute that into the current account in the future. Now, we're imputing no more than that which currently exists, but we're entitled, if one wants to extrapolate trends, to impute much more. And given the fact that investment is just so strong in these areas where we need it, the chances are that we will import, compete and export to the point where, notwithstanding the current levels in the terms of trade, the current account deficit may in future fall below 3%. At what point you get to the point where you're not adding any debt depends upon the level of capital inflow, will it be at its trend rate, the level of capital outflow to husband these companies of ours offshore, and the attendant debt which we need to cover that, and the dividend stream coming back. But it all looks pretty good in terms of what we are doing, and that is we have gone out in the world, we are joining the world of international commerce, as I said in the speech last night, we've entered the new age of Australian internationalism.
Greg Walker.
Greg Walker, ABC Radio. Mr Keating, at a time when the government is moving toward opening up higher education to more students, particularly those wanting to enter science and technology-based courses, why did the CSIRO suffer fairly substantial cuts to its budget this year?
I can't. It's all part of the science budget, and I can't, off the top of my head, recall precisely what we did with the CSIRO. My recollection was that there were not substantial cuts in real terms to its budget, but I'd need to check that.
Tony Allen.
Tony Allen, Macquarie News. Back to the vital matter of beer. When considering a cut in the price of beer, did you take into account the harmful effects of this beverage, like its effect on the road toll? Why did you cut the price of full strength as well as low alcohol beer? And given all the pleas you've had from the wine industry over the years, did you ever consider cutting wine instead of or as well as beer?
Well, wine has been much more lowly taxed than beer. Beer has been very heavily taxed. And we did consider it, and that's why we changed the excise in favour of low alcohol strength beer. We tried to encourage consumer preference to lower alcohol beer. But given the fact that there's probably a certain amount of inelasticity in the beer market and that people will drink it at any price, we had thought perhaps we could reduce the price, but in doing so we've put a sales tax of 20% on it, the same as all other beverages including wine. They are uniformly sales taxed at 20%, but the underlying excise structure reflects only alcoholic content, which has been skewed in favour of low alcohol beer.
Ken Randall.
Treasurer Ken Randall from Business Review Weekly. Just probably going back in your terms to the previous question, one of the points made in the detailed discussion of the budget papers last night is the conclusion of your advisers now that the improvement in competitiveness that we've sought for so long doesn't bring automatically, and perhaps not at all, the choking off of imports that we would have hoped for in earlier times, and that in fact the trend towards specialisation in industrial countries is tending to have the reverse effect. Despite the fact that we are getting this base of investment offshore and can expect a dividend stream from it in the future, don't you think that poses a problem in terms of the time available to us to correct the debt ratio, which, again, your advisers say they're not even confident yet has been peaked or has stabilised?
Well, Ken, one of the things about entering the world is you enter the world of commerce, and a trend around the world where commerce is in fact conducted more competitively, more openly, is higher import penetration ratios than perhaps in economies like Australia's. And it is no, I suppose, aberrant thing that import penetration ratios have risen as we have entered more fully into trade and commerce with the rest of the world. But again, there's a very interesting chart on page 40 of the budget papers, which deals with endogenous import penetration ratios excluding computers and data equipment. And you'll find with that exclusion that the import penetration ratios are very much like the trend of the mid-70s to 80s, and that the rise in import penetration netted out of the things that we don't produce is not as profound as perhaps people would believe. And the best way, I mean, the fact is we are now supplying so much more of our domestic demand from locally produced goods. And the more we see this investment go in, the more that's likely to happen, and the more likely we will bounce imports off us. The more competitive we are, we get that inflation rate down, you'll bounce the imports off you. And while there may be a general tendency to lift import penetration worldwide, it won't be one which mutes our current account gains.
The Treasurer now must rush off and do it all again in question time, so we'll call an end to the questions. the regularity with which the Treasurer visits our club means that we've simply run out of ideas and gifts
No more ties,
No
please.
more ties, please, he says. And he's not at all upset about that. But that, of course, doesn't diminish our gratitude for your visits, and we hope they continue. Thank you again.
Thank you very much. Well, I certainly enjoy the opportunity of coming, Russell, and I have a stock of ties, but they're all of that crook polyester variety. And if you can get around to a snazzy designer, Australian designer, silk one, well, you might find a whole new market opening up. Thank you. No, they're too horrible.
Look. It's designed by the board. Yes. See you later, mate.
I'm back. Just a watch. Well, it's the only seat they could find me. Only seat. Aren't we privileged to have you? Listen, John.
You go.
Yeah, that's quite right. I noticed
Didn't turn it over, but it seemed to be still going on.
Oh, Jesus, you can say that again. I would have thought more than a half.